The school district offers two flexible spending account plans and a pre-tax premium payment option. The flexible spending accounts include a health care reimbursement flexible spending account and a dependent care reimbursement flexible spending account. Your flexible spending account election amounts are deducted from your monthly gross earnings pre-tax. This means your elected flexible spending account amounts and pre-tax premium amounts are deducted from your gross earnings before the calculation of federal tax, state tax, Medicare tax, and your mandatory Public Employers Retirement Association contribution. Also, your pre-tax premiums and contributions to flexible spending accounts will reduce your salary reported to the Public Employers Retirement Association. This may result in a reduction of your PARA benefits you will receive when you retire. PARA members may want to carefully consider whether to participate during their 3 to 5 highest earning years, as pre-tax flexible spending deductions could reduce your PARA retirement benefits for the rest of your life. Because flexible spending accounts provide tax advantages, the federal government imposes strict rules and limitations on enrolling, making changes, or using these accounts. You should consult your tax advisor or the IRS for guidance on how these options might affect your personal tax status. You should contact the PARA Employees Retirement Association on how these options may affect your retirement benefits. The pre-tax premium payment options allows you to deduct premiums for health, dental, and vision coverage from your paycheck before the calculation of federal, state, and Medicare taxes and your mandatory PARA retirement contribution. This pre-tax premium payment option reduces your taxable income and PARA includable salary and increases your take-home pay. The Healthcare Flexible Spending Account, or Healthcare FSA, can only be elected if you have chosen the Kaiser DHMO Health Plan, the Kaiser Added Choice Deductible Coinsurance Plan, also known as the ACDC plan, or if you are enrolled on a plan that is not a qualifying high deductible health plan. The Healthcare FSA is like a savings account that allows you to have money deducted from your paycheck before it is taxed to pay for eligible healthcare expenses that are not covered or reimbursed by insurance. As you pay for qualified expenses, you reimburse yourself from your flexible spending account. The plan year is July 1st through June 30th. Remember that flexible spending account expenses must be incurred within the plan year or the funds are forfeited. You must contribute a minimum of $30 per month or a maximum of $200 per month or $2,400 per tax year to your healthcare flexible spending account. The FSA enrollment form requires you to elect an annual plan year amount. If you enroll during the annual open enrollment period in May, the annual FSA amount will be divided over the 12 months of the plan year, which is July 1st through June 30th. For new employees, the FSA election deduction will begin on the first paycheck and continue through the following June payroll. It is important to note that you will have to re-enroll during every annual open enrollment period if you wish to continue participation in the FSA the following plan year that begins July 1st. The IRS will not allow you to make contributions to both a healthcare flexible spending account and a health savings account. When you incur eligible healthcare expenses, you submit a FSA claim to HealthSmart, the flexible spending account administrator. HealthSmart will reimburse you by sending a check to your home address. The IRS allows 2.5-month grace period at the end of the plan year to allow plan participants to incur expenses before losing money in their flexible spending account. The 2.5-month grace period ends on September 15th, and claims must be submitted to HealthSmart by September 30th for reimbursement. It is very important to carefully calculate your annual election amount, since any money left in the FSA account after September 15th will be forfeited. For more details on qualified healthcare expenses and how the account works, please refer to the HealthSmart website at www.healthsmart.com. See IRS Publication 502 located on the District 27J Benefits webpage for more information on what is considered a qualified medical or dental expense. Please note that over-the-counter drugs are not eligible medical expenses unless you have a physician's written prescription for them. The Dependent Care Flexible Spending Account allows you to contribute pre-tax earnings to an account that is used to pay for dependent care, childcare, or daycare expenses. Reimbursements from your dependent care flex spending account may reduce or eliminate dependent care tax credits allowed on your federal income tax return. For most people, reimbursements from this flexible spending account provide a greater tax benefit, but everyone's tax situation is different, so it is best to discuss your situation with a tax advisor or refer to the IRS for guidance. The Dependent Care Flexible Spending Account can be used to provide daycare for your children under 13 years of age and or your spouse or other dependent who is mentally or physically incapable of self-care and who live in your home at least 8 hours a day. You may contribute a minimum of $30 per month and a maximum of $416.66 per month per household. The IRS imposes a $5,000 maximum contribution per tax year, January 1st through December 31st. If you are married and file separate tax returns, each of you have $2,500 maximum dependent care FSA contribution limits. The flexible spending account enrollment form requires you to make an annual plan year election. If you enroll during the annual open enrollment period in May, the annual FSA amount will be divided over the 12 months of the plan year, which is July 1st through June 30th. For new employees, the FSA election deduction will begin on the first paycheck and continue through the following June payroll. Reimbursement is limited to the balance in your dependent care FSA account at the time your claim is submitted and you must incur expenses prior to reimbursement. It is important to note that you will have to enroll or re-enroll in the plan during the annual open enrollment period if you wish to continue participation. The first payroll deduction of the new plan year will begin the July payroll. When you incur eligible expenses, you submit a claim from HealthSmart, the flexible spending account administrator. They will reimburse you by sending you a check to your home address. The IRS allows 2.5-month grace period at the end of the plan year to allow plan participants to incur expenses before losing money in their flexible spending dependent care account. The 2.5-month grace period ends on September 15th, and claims must be submitted to HealthSmart by September 30th for reimbursement. It is very important to carefully calculate your election amount, as any money left in the account after September 15th will be forfeited. For more details on qualified expenses and how the account works, please refer to the HealthSmart website at www.healthsmart.com.